I think silver is likely between now and the year end, and maybe sooner than that, take out its old dual highs at 50. First off, they're phantom highs, meaning when we were there before, it was very brief anyway, like hours or a few days before it collapsed. But even in real dollar price terms, adjusting for the degradation in the money unit, which goes and increases in supply about 90% every decade, silver would probably be $100, $200 right now just to match those highs. The game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000, okay?
Silver is approaching a decisive moment. For years, investors have fixated on the $50 level as an impenetrable ceiling, but history shows those highs were fleeting, more phantom than durable. Adjusted for the erosion of the dollar's value, silver would already be worth closer to $100 to match those past peaks. The reality is that the setup now is fundamentally different. Momentum is building, supply constraints are tightening, and the gold-silver spread is on the verge of a breakout. As momentum analyst MichaelOliver points out, silver's relative performance against gold is beginning to turn in silver's favor. That shift has historically triggered explosive upside, with silver often outperforming gold when both metals are rising together. The spread alone suggests silver could climb to $70 even if gold stood still, but with gold also advancing, the catch-up potential becomes far greater. In other words, silver's long period of underpricing looks ready to end, and the move higher could come faster than many expect. This isn't simply about technical patterns, it's about a market correcting years of distortion. Silver is not a forgotten metal, it's a suppressed one, and once it breaks out, the adjustment could be swift and dramatic. Now, we present the clips from MichaelOliver's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Well, for silver, I think we'll take out the 50 high, and I think you'd at least go to 60, 70. And at that point forward, once we cleared that high and sucked in a lot of late money, grabbing it, a wet bar of soap stuff, there'll be a point to take some profits on a trading basis. Not that the move is over, okay? But if you historically, and I've said this over and over, and I'm not predicting the price because they could go way beyond it, gold has had a couple eightfold moves. 1976 low to the 1980 high, eightfold gain. 2001 lows, 2011 highs, eightfold gain. Well, we started from a low at 1,050. You want to do the math? Somewhere between $8,000 and $9,000, you would simply be reflecting what it's already done twice in the last 50 years since the U.S. government legalized it. Okay? So to go to $8,000 now and gold would simply say, oh, it's doing what it did before, which isn't even abnormal. But what we're talking about is something far more abnormal. And therefore, you could go way beyond that on a fundamental or technical basis. But right now, even just echoing what it's done twice before, the same dimension move, you go to $8,000 gold, wouldn't shock me one bit. Particularly when these other factors start to come into play, which I think could be in the next month or so. Anyway, so that would give you an idea. Well, gold maybe go to 8,000. Well, that's just, again, it's just doing what it did before. Is that a top? No, probably not. But it's a statement of, goodness knows where silver might be then. You want to put silver at 2% of 8,000, okay? Anyway, that's what I think we're shaping up for. And I think it's going to be dramatic. And it's going to be very isolated, very focused in monetary metals and their miners. I think to some extent commodities will coattail, not lead, not cause, but coattail gold in this up move, much like they did in the late 70s, where commodities coattailed the bull market to the 1980 peak in gold. They didn't match it in terms of upside, but they did coattail it. And I think we could see that again. But I think it's not outlandish to think of $8,000 gold. Now, again, what does that mean? Well, a little more than doubling where you are now. Is that a big deal? I don't know. Not really. I think silver is likely between now and the year end, and maybe sooner than that, take out its old dual highs at 50. First off, they're phantom highs, meaning when we were there before, it was very brief anyway, like hours or a few days before it collapsed. But even in real dollar price terms, adjusting for the degradation in the money unit, which goes and increases in supply about 90% every decade, Silver would probably be 100, 200 bucks right now just to match those highs. Okay. And then put it another way. Either silver is totally a piece of something you don't want to own, or it's lagged and it's going to catch up. Now, what do I mean by lag? Look at copper. It's above its 2011 high. Gold, well above its 2011 high. Gold miners on Friday, XAU blew out its 2011 highs. GDX made a new high monthly close. Not above the intra-month highs of 2011, but a new high monthly close. And silver's at 40. Okay, 42, we're almost today. I think silver's going to do a big catch-up. And I think while gold continues up, and now it's come up out of its 5-month wide range, 3,500 to 3,200 back and forth, just sleepy as hell, but no real break. And silver gained during that time quite a bit. The spread is starting to favor silver now, meaning what's the better performer? Yeah, right now silver looks weak compared to gold when you go back to 2011 high, but what's been going on for 5 months is a lot more strength in silver. I think that's going to continue, and I think it's going to get explosive. And I think we're going to look down in, a couple months and we're going to say, oh, wow, finally, the beast is out above its all-time highs. It's like 60 or 70, which is sort of a broad working target we have for the next surge point, okay? Not that it's going to peak there, but that we're going to blast through those old nominal highs and not even pause until we get credibly out above them. And then maybe you get a correction of some kind. Not the end of the bull. But I think that's what we're facing right now. So yeah, momentum said, back in early June, watch out, I'm going to blow out the dual highs at 35. October of last year, March of this year, we dropped all the way down to under 28 in that period of time. And when we came back up through 34, got up to the upper 34s again, momentum said, you're gone, you're going to take off. And I think it's only just begun. I think anybody who pays attention to those old highs as if they're important is illusory. Okay, it's for the reasons you just described. First off, they're ancient, and and look around you at the other base metal, copper, gold miners now. And why is silver? It's a dog? No, it's not. It's just been overlooked, and investors quite often do that. They make mistakes. They underprice things, they overprice things. In the case of silver, it's vastly underpriced. We're also watching something that very few people look at. We keep the spread between gold and silver. The way we do it is we divide an ounce of silver to an ounce of gold and express it as a percent. Silver recently got a pullback low that was slightly below 1% of the price of gold. Well, in our weekend report, we showed going back to 1975, what was the highest reading that silver-gold spread reached in each of those years. And 20 of those 50 years, it reached at least 2%, okay? And in bull trends, like 79 to 80, 2010 to 11, silver was at 3.5 to 6%, the price of gold, okay? Right now, we're, above 1%, and we're pushing up, toward 1.2%. Not far above here, when we run momentum of the spread chart, we're going to get a breakout, and when we get that, we'd expect the spread to also break out. Now, there's a level on the spread at 1.31%. What's that? Over the last 5 years or so, there have been 2 rally highs in the spread that halted at that level. You ever clear that, it's a horizontal range breakout for the spread. And historically, if you go back and look at this performance of that relative performance of silver to gold, whenever silver's beating gold, is surging upward, that converts into net price upside in both metals, meaning silver doesn't outperform gold because gold goes down more than silver. It's always silver outperform gold when they're both going up. Get the point? So while everybody's looking at price, we're also looking at the spread, and it's about to engage in a major breakout as well. And when it does, I think that spread is at minimum going to go to the norm of 2%. Well, heck, that's almost a doubling of its current relative value. I think it occur easily by year end. Now, what does that mean? Well, it means, if gold just stood still and silver went to, 2% of it, silver would be $70 or so, But gold will be going up during that time. It's just that silver will be outpacing it. So we think right now the place to be most focused in terms of holding a position is in the silver component of the monetary metals.
Gold's momentum is quietly proving the doubters wrong. For months, traders had insisted that it needed a significant correction. Yet, instead of collapsing, the metal consolidated sideways, digesting gains while setting the stage for another surge. Every attempt to push it down was met with sharp rebounds, and now gold is again pressing decisively above the $3,500 level. That resilience is not a random market quirk. It reflects deeper structural forces at play. Analyst MichaelOliver notes that this period of horizontal price action wasn't weakness, but a reset in momentum. With global debt swelling, the dollar softening, and U.S. Treasuries losing credibility, gold is emerging as the clear beneficiary. Add in fragile equity markets, a vulnerable bond market, and even the risk of turmoil in the crypto market, and the setup becomes clear. Monetary metals are entering a different phase of the bull market. Let's get back to the interview.
Well, gold's momentum is positive. In the 5 months of horizontal price action we've seen, it allowed all the doubters, and there are ever doubters out there. It's got to correct, it's got to go back to 20, this level or that level, some old high, and it didn't do it. They sold into it repeatedly, like 3 times. It got up to 3,500 or 3,450. Right now, we did trade above 3,500 today, by the way, using October gold. They couldn't break it. They sold it, and they kept getting these $100 and $150 pullbacks, and then bang, you're back up again. So I guess they got taught a lesson that this is not some beast that has to correct big time. Instead, it had a correction by standing still for 5 months. And our work on momentum and clockwork of momentum, meaning often momentum swings can be measured on certain of our metrics in terms of how many months have been spent trending up on the oscillator or down on the oscillator. And for that 5 months, we've had a corrective downside process in momentum as it cooled off while price went lateral. The clock is old. We said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000, okay? But we're focused right now on MSA on this issue. This particular surge will not end the bull market, but it will be dramatic. And therefore, if you're invested in the monetary metals, particularly the silver side and the gold miners, which are now also outperforming gold, we're looking for points to take profits. But I'm going to tell you that in the case of silver, we're not looking for it, frankly, until we get to 60 to 70. As we've blown out the idiot highs, which means, pardon me, those who missed the move had ignored it and doubted it, will suddenly say, well, golly, I got to be in that, okay? And then you get a further gush of money into a fairly small market, which could easily goose it into that zone, and we've got some reasons for that zone. But ultimately, there could be a correction up there. Not the top. So if you're fully invested, unleveraged, ignore what I'm saying. Because I think we've been arguing that this move in gold and silver is different from the prior ones. This time, I think there's more fundamental and macro technical events going on globally and in major asset categories, not just a stock market top, which I think has been making since early this year. It's a widening top, but it's a topping pattern. But in certain other areas like the breaking of the dollar. Dollar has not been a factor, the dollar index, when you measure versus euro and yen primarily, that's 70% of the dollar index. It's been sideways since 2015 when gold made its low. It's trading around 98 right now. We're trading just below 98. So yeah, it's been above it and below it since then, but 10 years it's been net lateral. Well, why is gold not net lateral? It's triple and a half. So you don't just look at the dollar for driving gold, but it will help because it's now entered what could be a dynamic bear market. And dynamic on the downside could, in fact, be further win for gold. Then we go to the T-bonds. T-bonds are usually an alternative. If you have a perception of a weakening stock market, people will tend to move money into T-bonds as the alternative. They're not. T-bonds are very anemic. They're very weak. They're behaving more like the stock market in terms of when they make lows and highs. And right now, T-bonds, as we speak, are not far away from some levels that if they break below, you could end up getting a little mini bond market event, which would spook the stock market. Anyway, there's a lot of these factors out there, including Bitcoin, I think, which is in a potential crash situation. We've been saying that for a few months. Not that we're there. The trigger numbers are still below us, but if you hit those trigger numbers, that could suddenly become an off-the-sideline type, oh my God, where did that happen? How did that occur? And it will have wave effects because of financial institutions that are now so heavily involved in crypto. So anyway, these events are out there percolating, and I think they're going to occur. And when they do, that could create further upside panic in the monetary metals. And I think we're going to see that between now and the end of the year, possibly sooner than that. Well, we've had the inflation in the sense that the money growth continues. In fact, they're accelerating. The M2 money supply is making new highs now after a pause. That's an ongoing thing. That's why gold isn't $35, it's $3,500, okay? It's not because of any one single event or commodity inflation. And then, so the inflation really is always there. And that's why gold just keeps, over a period of time, it swings up and down versus that metric, but it's upward, just like the decay in the money units. But in the case of commodities, they don't explain. We showed in the weekend report the chart of gold since 2015, and there's this upward plotting action, and then it's accelerating. And you say, well, what caused that? And it wasn't because it was declining stock market, which helps gold. If you go back 2000, 2002, 2007 high in the stock market to 2009, gold went net up. There was one break in there, but it kept going up. But we don't have that right now. So it's not the weakening stock market yet. It's helping gold, so it will, because money will move. It's not reflected by the bond market. It's not reflected in commodities. The Bloomberg pullback from a high at 140 to either side of 100 back in 2022, dropped in 23, and then went sideways, has been dull for a couple of years. So it isn't commodity prices, so-called commodity inflation. You look around, and it's not the dollar. The dollar has been Deadsville. It's recently started to drop, but it's not precipitous yet. So how can you explain this? Well, because there's something bigger going on. It's not merely one of these things. It's a combination of things, largely built around the distortions created by government monopoly over money. And gold knows this. And later on, you'll see the headlines and you'll look back and say, oh, now I know why. But don't look for the reasons why to be in your face as it's doing it. Look for them later. Too late to be joining. Okay, not too late, but you're late. Okay, already you're late if you're not in. So that's why I think things will change more dramatically this time. Is that all these factors, not just one of them, all of a sudden now we have a lot of factors that are at the point of cascade, which would create what? Total panic on the part of central banks. The banks look very vulnerable technically, especially as we get into next month. All these events could cause the Fed to go berserk. The question is, will this game, this boom-bust cycle game where they come in, they try to put the fire out by printing a lot more money, buying assets, cutting interest rates below any reality point. Will that work again? We argue no. This time it won't. This time the boom bust will end in something more global and more painful to the average guy than 2008, for example, or the dot-com collapse. This time it's going to be more broadly felt. First off, we have the biggest stock bubble in U.S. history in terms of duration of years upside, the multiple gains in the price of the stock market. NASDAQ 100 went up like 20-fold from its 2009 low over a 15-year period plus, and S&P went up over 10-fold. There's no bull market in history that matches those dimensions. And when you look at money supply or you look at Fed funds rates, you can say, oh, now I understand why. They printed it higher. Okay. When that breaks, real world consequences occur. This time, I think they'll be so severe and also global, although we're a prime bubble. Some areas of the world aren't. China, for example, does not have a bubble situation. They may go down with us, but they don't have a bubble. But it will cause real world in the street consequences where certain things that we all take for granted but really have only been around this century, one very long human lifetime, such as central banks controlling what money is. Why should you have a government monopoly over the most essential commodity of human interaction? Money. Okay? It's as if government controlled the price of corn, determined how much is going to be produced each year and what its price is. Well, we would call that socialism, right? Okay? Which it, would be. Well, what controlling the most essential commodity in human interaction, a money unit, is even more manipulative and controlling and less free market than any action they've done. But when that process proves that it doesn't work and proves it in a way that's painful to too many people, then you have doubt. And not just among the average guy who's hurting, but academicians who look at these institutions and say, hey, this hasn't been working. It's just been this recurring process. Or like Jamie Dimon made a point, a month or so ago about the bond market situation. It's this constant process of the degradation in government debt in relation to its ability to, raise the money, et cetera, that it can't go on forever. This time it's going to be different. And we think he's right. I think it's going to be true. You're going to have a crisis that isn't just print-awayable this time. It will cause doubt and change in institutions. My bet is you won't have a Federal Reserve in a year or so. If events get real dark economically, you may not have income taxes. Why? Because it's simply dysfunctioning. Public can't pay it. And the IRS doesn't function in terms of the percent of revenue it's supposed to bring in. So, they go to sales tax or something. But all these kind of things that we think as norms could go out the window. And the same is true with the monetary metals. This time we think when they go up, they're likely to stay up, meaning become institutionalized again here, there, this country, that country, as money.
Gold and silver are moving beyond the realm of speculation and into the center of a larger monetary shift. The 5-month consolidation in gold and the breakout strength in silver indicate a new phase where precious metals are no longer viewed as secondary assets, but rather as primary indicators of instability in the fiat system. Momentum indicators, relative strength spreads, and historic performance ratios all suggest that what we are seeing now is the early stage of something larger, a repricing of real money against decades of monetary excess. At the same time, traditional safe havens like U.S. Treasuries are weakening, while equity markets show signs of strain after years of artificial support. In such an environment, gold and silver are not just hedges, they are becoming the focal points of capital preservation. The pattern is clear. When faith in paper weakens, tangible value rises. This time, the structural cracks are wider, the debt levels are higher, and the stakes are global. Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.